For the next 8 days, one of the most powerful forces in the global precious metals market will be completely offline. No Shanghai trading, no Chinese commodity markets, no mainland price discovery. From February 16th to February 23rd, China shuts down for Lunar New Year. And that single event could create one of the most dangerous liquidity environments of the entire year. Because this isn't just a holiday. This is 8 full days without the world's largest gold buyer, the largest consumer, and one of the most dominant forces in the global silver supply chain. And all of it is happening just days before the most important silver delivery window of the year. The event, 8 days without China. Starting February 16th, China's major financial markets close. The Shanghai Gold Exchange, the Shanghai Stock Exchange, and the key commodity exchanges that normally help anchor global price discovery. Some regional markets like Hong Kong and Singapore will reopen earlier, but mainland China, the real heavyweight, stays closed for the full period. And that matters more than most investors realize. Because when it comes to precious metals, China isn't just a participant, it is the participant. China is the world's #1 gold miner, producing around 370 tons a year. The world's largest gold importer, bringing in more than 1,000 tons in the last year alone. And the world's largest gold consumer. At the same time, the People's Bank of China has been buying gold for 15 consecutive months. Quietly, relentlessly, month after month. And silver? China controls roughly 60 to 70% of the world's refined silver output. And as of January 1st, 2026, they've implemented export restrictions that effectively lock a massive portion of that supply inside the country. So when China shuts down, the global precious metals market loses its largest physical anchor. Why this creates a liquidity crisis. Here's the key idea most traders overlook. When China's open, there are 2 major forces balancing the market. The physical market in the east, and the paper market in London and New York. But when China closes, that balance disappears, and price discovery shifts almost entirely to Western paper markets. Futures, forwards, derivatives, paper trading against paper. What does that mean in practical terms? Liquidity dries up, order books get thinner, spreads widen, and small trades start creating big price moves. In a normal environment, a $50 million order might move gold $5, but in thin liquidity, that same order could move gold $20 or $30. Silver becomes even more volatile. A 10-cent spread can become 50 cents or more. And suddenly, tiny imbalances turn into massive swings. When liquidity disappears, algorithms take over. Here's where things get dangerous. In thin markets, human traders aren't the dominant force. Algorithms are. High-frequency systems scan for weak liquidity conditions. And when they find them, they exploit them. They push prices into areas where stop losses sit. They trigger margin calls. They accelerate downward moves. And what starts as a small sell-off turns into a cascade. We already saw a preview of this on January 30th, during a thin liquidity window ahead of Lunar New Year. Silver crashed 35% in a single day, the worst one-day move in its history. Gold dropped 12% at the same time. And that happened with only partial Asian liquidity disruptions. Now imagine 8 full days without China. The timing couldn't be worse. If this were happening in a quiet part of the year, the risk would be manageable, but it's not. Because while China is offline, the COMEX silver market is heading straight toward its March delivery cycle. And that's where the real tension is building. The COMEX powder keg. Here's the situation. March 1st, notice day is approaching fast, and the numbers are starting to look uncomfortable. COMEX registered silver, the metal actually available for delivery, sits at around 103 million ounces. But open interest for the March contract represents 400 to 500 million ounces in paper claims. That's a massive mismatch. And inventories aren't stable. They're draining at a rate of roughly 785,000 ounces per day. Over an 8-day period, that's more than 6 million ounces leaving the system. By first notice day, registered inventory could drop to around 93 or 94 million ounces. Now consider what happens if investors stand for delivery. If 40 to 50 million ounces are demanded, COMEX survives, but inventories get severely depleted. If 80 to 100 million ounces are demanded, the exchange faces a serious problem because the metal simply isn't there. The JP Morgan factor. In January, one major player stepped in. JP Morgan issued 99% of all silver deliveries, more than 8 million ounces. That suggests they were actively managing inventory flows to prevent disruption. But March is a much larger contract, and if demand spikes, even a giant institution may struggle to contain it. A market on a knife's edge. So now step back and look at the full picture. For 8 days, the world's largest physical metals market goes dark, liquidity dries up, algorithms dominate, and at the same time, the silver futures market approaches its biggest delivery event of the year, That's not a stable setup. That's a pressure cooker. In part 2, we'll break down the exact day-by-day playbook for this critical week, the 3 scenarios that could unfold, and the survival strategy traders are using to navigate the thinnest liquidity window of 2026. So now we know the setup. 8 days without China, thinner liquidity, algorithms in control, and a silver delivery cycle approaching fast. The market is entering one of the most fragile periods of the entire year. And in environments like this, price doesn't move normally. It overshoots, it whipsaws, and it punishes traders who assume this is just another week. So the question becomes, what exactly should you watch day by day as this liquidity blackout unfolds? The day-by-day playbook. Let us walk through the entire 8-day window and highlight the moments that could trigger major volatility. Monday, February 16th, Lunar New Year Eve. This is the last trading day before the full Chinese shutdown. It's the final opportunity for mainland traders to adjust positions. That means we could see sudden bursts of volatility, aggressive positioning, or even sharp price swings before the market closes. One key signal to watch: the premium difference between Shanghai prices and London prices. If Shanghai trades higher, it signals strong physical demand. If it trades lower, it suggests caution going into the holiday. Tuesday, February 17th through Monday, February 23rd. The full liquidity blackout. This is the danger zone. For 7 straight sessions, China is completely absent from price discovery. No major physical buyer, no balancing force against paper markets. This is when thin order books can turn small trades into massive moves. Any news event, economic data, Fed comments, geopolitical headlines can trigger outsized reactions. Wednesday, February 18th, FOMC minutes. Normally, this kind of release moves gold $10 to $20, but in a thin market, it could move $50 to $100 in a single session. The same goes for silver. A routine reaction could become a major breakout or a sharp crash. Thursday, February 19th, jobless claims. Under normal conditions, this is a secondary data point, but in low liquidity, even small surprises can create violent price swings. Good data could spark a sell-off. Weak data could ignite a rally, and the moves may overshoot in both directions. Friday, February 20th, Hong Kong reopens. This is the first real Asian feedback after several days of Western-only trading, and it's critical, because Hong Kong will either validate the price action from London and New York, or reject it. If Hong Kong buyers step in aggressively, it confirms strong physical demand. If they sell, it could trigger another leg lower. Monday, February 23rd, final day of China's closure. This is the last session before mainland China returns, and we're only 4 days away from first notice day for March silver. Expect position squaring. Traders may reduce exposure, roll contracts, or close risk before the delivery window. This day could be extremely volatile. Tuesday, February 24th. China reopens. This is the moment of truth. After 8 days of Western price discovery, China returns, and the market gets its answer. If Chinese buyers rush in, prices could spike in a wave of FOMO. If they hold back or sell, it signals a reassessment of the rally. Either way, this day sets the tone for the rest of the month. The 3 scenarios for the week. With liquidity, thin, and delivery pressure rising, the market is essentially binary. There's no smooth, middle-of-the-road outcome. Either the system stays stable, or it experiences extreme volatility. Here are the 3 most likely scenarios. Scenario 1, orderly consolidation. Probability, 40%. In this case, nothing extreme happens. Economic data comes in neutral. Hong Kong validates Western prices, and China reopens without major disruption. The navigation strategy. So how do traders handle a week like this? The answer depends on what you're holding. Physical holders. If you own physical gold or silver, the strategy is simple. Do nothing. This volatility is noise. The real event is March 1st notice day, not this week's price swings. Futures traders. If you're trading leveraged contracts, risk management becomes everything. Position sizes should drop by 30 to 50%. Stops should be wider, and overnight holds should be avoided when possible. Options may be a better tool because they define your maximum risk. ETF and mining stock traders. Expect wider spreads. Silver ETFs that normally trade with 2-cent spreads may widen to 10 or 20 cents. Mining stocks could swing 3 to 5% per session. Volatility will be elevated. The golden rule. Don't try to front-run the crash, and don't try to front-run the squeeze. Because in thin markets, even correct ideas can get wiped out by bad timing. Survival is the edge. Preserving capital is the strategy. So you're still here when the real move begins. Final verdict. This week represents the thinnest liquidity window of 2026, and it S colliding directly with peak delivery pressure for March silver. The setup is binary. Either the market fizzles or it explodes. China reopens on February 24th. First notice day arrives on February 27th. That accumutas when the real story gets written. Your mission this week is simple. Reduce risk, watch the levels, survive the volatility, and be ready for what comes next.